Hello, I'm Bernard Hickey with the daily briefing from interest.co.nz. Today we'll look at the rout overnight on global stock and foreign exchange markets and look at what it might mean for interest rates here. We'll also look at the latest news on term deposits, where a couple of banks have actually cut their 6th and 12-month rates. That in a moment. But firstly, let's breathe deeply and smell the panic in the air. There was plenty of it overnight, where European and Asian stock markets had their worst days since 9/11. And we saw a slump in any assets perceived as riskier than government bonds. And that included the Kiwi dollar, which fell to a 3-month low of 74.5 US cents. Now this is all about fears of a US recession and the continuing fallout from the subprime mortgage credit crunch. You may remember this idea that the Asian and European economies might actually decouple from the US economy, and therefore a US recession might not matter. Well, that idea is now back in its box. Chinese authorities came out and said overnight that China is definitely dependent on US growth to suck in Chinese exports. Indian stocks fell 7%, Hong Kong was down 3%, and European markets were just as spooked. Signs emerged that the German economy is slowing too. It's also quite dependent on exports to America and Asia. But what does this all mean for New Zealand and our interest rates? The first thing to note was the sharp fall in the New Zealand dollar overnight to a 3-month low of 74.5 US cents. That's all because of this global aversion to risk. You could also just call it fear escalating to panic. It scared investors away from currencies and bonds that are seen as risky. The Kiwi dollar is labelled as one of the carry trade currencies. That's where investors borrow cheaply in Japan or Europe and lend it in New Zealand dollars at much higher interest rates. Now that's all fine when there's a big gap between Kiwi and Japanese interest rates, which we have right now, and it's all fine when the currency is rising. If, however, the Japanese housewives and Belgian dentists who own these bonds get a little bit nervous, they could choose not to roll over these Eurodashi and Euro-Kiwi bonds, which could trigger an exodus and a New Zealand dollar crash. Now there's no sign of that right now. Most people don't know it, but right now out on financial markets, Toyota is selling $685 million of Eurodashi bonds, and the Inter-American Development Bank is selling $415 million of these Eurodashi bonds. This is essentially to roll over existing debt. Now this fall in the currency is great news for exporters, but it won't help the Reserve Bank keep a lid on inflation if the currency move sticks. The Reserve Bank makes this decision on interest rates on Thursday. Now this is the other big implication out of this turmoil. Most believe it is extremely unlikely the Reserve Bank would hike interest rates at a time of such global financial turmoil. So the end result for New Zealanders? Official interest rates are on hold for now. Talking of interest rates, let's look now at what's happening here in the term deposit market, where perhaps surprisingly, we're seeing some banks actually cut their term deposit rates. Again, ANZ was the first to move. It cut its 6-month term deposit rate to 8% from 8.5%. However, it introduced a new 8-month rate at 8.5%, and its 1-year rate remains the most competitive of the banks at 8.9%. Elsewhere, Kiwibank cut its 1-year term deposit rate from 9% to 8.9%. Now this all seems counterintuitive at a time when generally interest rates are rising. It certainly won't hurt bank profits, because at the same time as cutting some of their deposit rates, the rates on the other side of the ledger for fixed mortgage rates have been increased around 20 basis points to about 9.9% for a 1-year fixed mortgage rate. The banks have blamed higher wholesale interest rates for this because of the global credit crunch, although it's worth noting that the 2-year swaps rate has actually dropped around 20 basis points in the last couple of weeks. Dealers say, however, that the margins banks pay above the swaps rate has increased around 20 basis points to 50 basis points, meaning bank funding costs haven't actually risen in the last couple of weeks since that last round of mortgage rate hikes. The other thing worth seeing is that the banks are having no trouble attracting lots of cash into these term deposit accounts right now. As we reported yesterday, cash flows into bank term deposit accounts more than tripled in the September quarter to over $3.5 billion. That's because investors are fearful about finance companies and they see weak stock markets at the moment. It may also be a bit early to call these moves by ANZ and Kiwibank a trend. Both ANZ and Kiwibank have the leading bank rate for 1-year term deposits at 8.9%. The best rate from the banks right now is from Westpac, which has a 15-month special at 9%. That's still plenty attractive at a time when global stock markets are slumping. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. See you tomorrow.